Top of the heap right now is what's happening on Wall Street. The main indices, they've opened lower on Thursday. This as data has signaled a more resilient labor market. Hawkish minutes of the Federal Reserve's June meeting as well, fanning fears that the central bank could keep those interest rates higher for longer. Currently, what's happening? Dow Jones is down about 1.5%. The Nasdaq also around 1.4%, and the S&P 500 is down about 1.25%. It's a sea of red across the board. And of course, we'll continue to track it as we speak to Peter Cardillo. He's joining us, Chief Market Economist at Spartan Capital. Great to have you with us, Peter. We are seeing a sea of red right now on Wall Street, spurred on, of course, by the minutes of the Fed's meeting. But of course, those jobless claims, as far as the labor market is concerned, it remains as resilient as ever. Are these two factors the reason why we are seeing this kind of red?
Absolutely, but I think the real reason is the ADP numbers, which showed that the private sector added 497,000 jobs last month. And of course, that's a very strong number. And certainly it doesn't bode well in terms of a weak jobs report tomorrow. Of course, ADP in the past made some pretty big errors, but they've been somewhat consistent over the past 6 months. So if these numbers should show up in tomorrow's tomorrow's labor report, then I think it's further confirmation that the job market is just very, very, very strong. And I kind of and I think one of the reasons for this is after 10, 11 straight hikes in interest rates, you continue to see jobs creation. And it's somewhat puzzling. But I think we have to all admit to one fact, that the post-pandemic era has changed the calculations of job openings.
It sounds, Peter, what do you think the Fed is going to do next? Because it finds itself in a deep spot of bother, and the market seem rattled by the possibilities.
Well, there's no question that if the numbers continue like this, they're going to have to raise rates. I mean, they said it in the minutes. Powell has said it over and over again. They seem to have placed in the dot plan at least 2 more rate hikes. But there are other numbers to take into consideration. So let's break them down. And of course, tomorrow's labor report, the key will be hourly wages. Now, if you have strong jobs creation and you don't have a big hike in wages, well, that's not negative. That's actually positive. So we need to take that into consideration. And the other factors, obviously, are the inflation data. In fact, next week we have the CPI and we have the PPI final demand. If those numbers should come in on the cool side, then, there's a possibility that the Fed may hold off and say, let's re-examine the jobs data in September. So I think it's a long shot, obviously, but maybe the Fed might actually skip in July and monitor the inflation numbers in September.
It's hearing you speak right now because that would kind of smoothen some ruffled feathers. For the moment, we are seeing those deep cuts come in, Peter, and we'll continue to see what the markets do next. Thanks very much for joining us with your perspective. Always a pleasure to speak to you, Peter.